Strategies webinar. Our topic today will focus on charitable giving. We're joined today by Scott Grenier, Manager of Tax and Estate Planning at Baird, and Jonathan Raymon, Charitable Solutions Strategist at Baird Trust, as they lead an informative discussion highlighting what you need to know about the possible charitable solutions and what strategies can be implemented when giving. For those of you unfamiliar with Scott, Scott joined Baird in 2010 and is currently the Manager of Estate and Tax Specialists for Baird's Private Wealth Management Group. Scott's expertise lies in the area of estate planning, and when he's not managing the team, he's helping financial advisors review their clients' estate plans and conducting seminars. And for those of you unfamiliar with Jonathan, Jonathan provides trust administration and client service, focusing on charitable trusts and charitable organizations. He has 10 years of experience in the investment industry and holds the Certified Trust and Fiduciary Advisor designation and the Chartered Advisor in Philanthropy designation. Jonathan is a member of the American, Kentucky, and Louisville Bar Associations and a member of the taxation section of the Louisville Bar Association, previously serving as chair. Before I turn the call over to them, I do have a few housekeeping items that I'd like to highlight. For optimal viewing, we would suggest setting your layout to the side-by-side view via the circle in the upper right-hand corner of your screen. All participants are in a listen-only mode, but we would love to hear from you. So I know Scott and Jonathan will be answering questions throughout the presentation. Then we will also host a Q&A session as time permits at the end of today's webinar. You can submit a question by clicking on that Q&A icon on the bottom right-hand side of your screen. We just ask that when you submit a question, you submit it to all panelists. This presentation is being recorded and will be made available along with the slide deck through your Baird Financial Advisor or via bairdwealth.com in about a week following today's webinar. With that, Jonathan, Scott, thank you so much for joining us. Scott, I will turn the call over to you.
Great. Thanks, Justine, and thanks for setting us up for the call today. Super excited to be here today with Jonathan Raymon, who works in this area all the time, and his specialty is someone that I rely on here at Baird. We both have the CAP designation, Chartered Advisor in Philanthropy designation, and it's an area that is near and dear to my heart, whether it be from volunteering or through the use of dollars, whether it be through contributions going directly to charities that my family has been involved with in the past and has been closely associated with, and or by working with Baird and our Baird Cares Days, where we can take our day from the office and go give back to the community. So excited to be here today to talk about the variety of ways in which individuals can give back to their communities, whether, again, it is financially through the means of various different assets you might have or volunteering your time, both of which are extremely valuable and necessary in today's society for these charities to continue to prosper and grow for the future. So I'm going to get things started here. Obviously, the title is our Charitable Giving Strategies, helping you achieve your philanthropic goals. That is what is most important to you, and there's a variety of ways in which things can be done. You'll often hear Jonathan and I say that there's not a single way to do things. Each and every situation is unique and different, and just because one client may exercise a certain strategy does not mean that is in your best interest to exercise that same strategy. It's something to become familiar with, but also understanding the different types of strategies and how your situation can be different than others is something that we want to make sure we're learning more about and asking those questions of you to learn what's important for you. But let's start with where we are today, and let's talk a little bit about past giving. 2022, a total of just under $500 billion of assets being gifted to a variety of charities that are out there. You'll see that a majority of the gifting is coming from individuals, $319 billion of giving coming from individuals each year. All right. The types of giving recipients, obviously the largest here is religious organizations, followed closely by educational institutions. But each and every one of you has a different giving process and a different type of charity that you might be interested in giving to. Reasons we often see our clients giving to charities, or why I might give to charity, is to promote a specific cause, see my dollars at work during my lifetime. Never hurts to receive a current income tax deduction if I'm able to itemize my tax deductions, which we'll talk about. And in some scenarios, I might also retain an income stream if I set up a different type of vehicle where an income stream can be paid back to me, and I can transfer that appreciated asset most of the times to an entity in which the income stream will be paid back to me, knowing that at the end of a term or the end of my life, the residual balance will then go to that charity of my choice. And so let's talk about what we see here in a gifting strategy. So between gifting of assets and time, right, time being that volunteering time, about 2/3 of the US population is donating in some way, shape, or form at this time. Yet, less than 6% of individuals have a bequest, a specific dollar amount, planned in their estate plan. Could be a percentage, could be a dollar amount, but less than 6%. So we're seeing a lot more giving during lifetime and less when someone passes away for the reasons mentioned before. Being able to see your dollars at work, being able to influence the causes while you're alive. What's important, I think, as we move forward is looking at the gifting by generations. And when they're talking about the silent/greatest generation and the boomers, who are obviously giving the largest percentage of individuals that are contributing to charities, all the way down to the millennials and Gen Z and Gen X, who have some work to do to catch up to those other generations. Now, again, as we talk about this, it doesn't always have to be financial contributions, but rather volunteering. And I think it's important that we think of these older generations and how they can influence the younger generations of giving in the future. Is it through time? Is it through monetary assets? Are there some vehicles that the older generations could set up that could otherwise help the younger generations to become more involved in the charitable giving space and giving back to their local communities and to other organizations? And so why do we think about leaving a legacy? We mentioned that less than 6% of individuals are doing this within their estate plan, but what the 6% are thinking of is supporting and encouraging your values in the community, right? Predetermining what assets you might want to give in the future and how those assets will be used by that organization, creating a structured plan. Oftentimes, Jonathan and I will see a lot of individuals that will think very deeply about the organizations they want to give to, but then they stop at who they want to give to and don't think further as to within the organization, what type of causes do they want to promote? Are they trying to give to the general resource fund of the organization, or do they specifically want those dollars to be used by that organization in a meaningful way that is meaningful for that person? That's creating a lasting memory for your vision. And again, to serve as this example for future generations. I can't reiterate how important it is that we get the younger generations doing more in their communities, volunteering their time if they don't have the financial means to do so, and be able to piggyback maybe off of those older generations that may have those financial resources, and setting up the younger generations so that they can be involved in giving to charities in the future. So let's talk about what happens without a charitable giving plan. Let's talk a little bit about Prince, right? Prince did not have an estate plan in place, never mind a charitable giving plan in place, right? It was a complete mess. The size of the estate, trying to figure out and determining the value of the estate versus what, with his music inventory as to what the value was and the assessment of estate taxes owed. We're looking here, right, at about 90 million of estate taxes between the federal government and the state government. All right, what could Prince have done with that $90 million had he decided to create an estate plan and create a legacy for future generations and within the community in which was so important to him, right? That continued philanthropy by including individual charities, creating a private foundation or a donor advised fund or another type of vehicle could have been much better spent than potentially giving it to the government. So we've talked a little bit about why people do the gifting strategies, and we mentioned that the income tax deduction is oftentimes maybe a reason that some of our clients will consider gifting in one particular year over another. Let's talk about the income tax deduction basic rules here. First, we have to figure out why does it matter, right? The gifting rules and what we're giving to charity and the income tax deduction rules matter when it comes to how much taxes you're going to pay and or how much in taxes you might save by giving to charity. But first, we got to know that the amount that is deductible depends on the type of asset you're giving and depends on the type of charity that is receiving the donation. For example, are we giving cash? Are we giving marketable securities? Are we giving retirement assets? And who are we giving those assets to? Are we giving them directly to a public charity, a 501c3 organization? Are we allocating those assets to a donor advised fund or a private foundation? The type of charity will dictate, along with the type of asset, what type of charitable deduction you can expect to receive. So another thing we also need to think about is if we are giving marketable securities, we have to think about what we call non-qualified positions. And non-qualified positions are going to be short-term holdings. So what is the difference between short-term and long-term? Well, a long-term marketable security goes from the trade date plus a year and 1 day. So 366 days, unless we're including leap year in there. Okay, but think about a long-term transaction and why that is of importance. If we donate short-term holdings, things that have been held for less than that year plus a day time frame, then the deduction we're getting is only equal to the cost basis. And more, and as importantly, the difference between the cost basis and the fair market value of that security that may have appreciated during this time is taxable as if the sale had occurred and was given to charity thereafter. Whereas if the marketable security is held long-term, then your deduction is up to the fair market value of the security of presumably this appreciated asset. And the donation does not create a taxable event for the client. Very important as we think about reviewing portfolios and what type of assets we might want to give. Additional constructs we think about in giving marketable securities is reviewing portfolio allocations. Do our clients have concentrated positions? Concentrated positions can be great when you're growing your wealth and the market is going up. But what happens in a volatile market when that concentrated position shifts your net worth dramatically and creates this fear inside the individual of being able to maintain holding on to those securities during those more volatile periods of times? Maybe we have some securities have reached their price targets or face challenges in the current economic environment, potentially face lawsuits and or have some future technology changes that may change the way in which they do business or new rivals entering the marketplace. We also want to identify asset allocation and determine if there's an asset category that may be overweighted due to the fact that there are some positions that have increased in value at that time. Okay. So as an example, we have an individual who wants to give $25,000 of marketable securities. The individual owns $75,000 of XYZ stock that is long-term and $25,000 of other equities. XYZ's reached a new high recently, but is facing stronger competition from their rival. In this strategy, it seems pretty sound position for us to take that the gifting of $25,000 of XYZ would reduce that individual's concentrated position, reduce the individual's over allocation to a specific asset category, and provides the individual with an opportunity to give the least amount of shares to achieve their individual goal. Using those higher price targets allows you to use a lower number of shares to meet the target gifting that you want to achieve. Okay. Now we're going to take another strategy, and this is going to follow through for the next page or so. So I just want to lay out that this is Tom and Lucy, both earning approximately $180,000 combined. They have their 401k, and they have a daughter that has just started college with a full scholarship. Boy, I hope my daughter gets a full scholarship because that would be great with 3 kids and their educations coming up. I have a feeling I'll be working a lot longer here, but great for them to have their daughter with this full scholarship. But in doing so, and they also have a trust that has recently terminated when Lucy's father had passed away last year from cancer. The trust had been established by Lucy's grandfather. So when it transferred from Lucy's father, who was the beneficiary of the trust, to Lucy, it did not receive a cost basis adjustment when the trust was terminated. Lucy's been deeply impacted by the loss of her father, and they've agreed to donate 10% of their earnings going forward to cancer research. So if we look at Tom and Lucy and how they might want to gift, let's take two different scenarios of gifting cash versus gifting appreciated assets. Scenario one, Lucy is earning $95,000. Tom is earning $85,000, and there's capital gains that they would have to recognize of $17,500 in order to be able to gift the cash that they want to gift to the charity. They need to replenish the cash. Maybe the cash is sitting in their bank account and they're going to use that $17,500 from their bank account, but they need additional liquidity to replenish the use of that $17,500 for their emergency reserve cash fund. In this scenario, the client is going to look at what their deductions might be and whether they're going to use the standard deduction, which is the $25,900 for a married couple, or whether they're going to itemize deductions, in which case their charitable contributions combined with their mortgage interest and property taxes would allow them to have an itemized deduction amount that is greater than their standard deduction. In this case, the income tax due on the net income or their taxable income would be $26,401. Whereas scenario two, if Lucy and Tom were to actually gift the highly appreciated stock, well, they wouldn't have the capital gain recognition. They wouldn't have to replenish their cash reserves. They would still have the itemized deduction strategy by giving to charity, but their income tax liability would decrease from $26,400 to $22,500. Okay, so as we look at gifting assets, it's important to understand our clients' cash positions, their appreciated assets, specifically those securities that have been held long-term, and what the potential gifting of appreciated stock might do, not only from a tax perspective, but also what it might do from the overall portfolio construction perspective. Okay. So when we think about income tax deduction rules, we mentioned that if Lucy and Tom were to give $18,000 or 10% of their income each year, and they were to use these long-term held marketable securities, then they could ultimately receive this income tax deduction. But these income tax deductions are limited, as we mentioned earlier, to one of two things. It's either limited to the dollar amount in which you gift, the fair market value, or your cost basis, as we talked about, if you were to give marketable securities that are held less than a year. And then it also depends on the type of charity that you're giving the assets to. So for example, under the public charity column, you'll see here as we go left to right, if we give cash, it's the fair market value of the cash, in this case, $18,000 that Tom and Lucy were giving, but it's limited to 60% of their adjusted gross income. In other words, if Tom and Lucy were to go ahead and give their, let's say their adjusted gross income was the $180,000, they would be limited to the 60% of the $180,000 for the year. So if Tom and Lucy were to then give $100,000, they would not be able to deduct the full $100,000 in the current year. They would be able to deduct up to 60% of their AGI for the current year. Okay. Then the additional cash that they had gifted to charity in 2023 would carry over for the next 5 years and would be deductible in those years, starting in 2024, to use up the remainder of that addition, the $100,000 gift that they have, up to 60% of their AGI in 2024. And so as you look at this chart, just look to see whether or not the assets that you're giving would be fair market value or cost basis, depending on the type of asset you're giving and what type of charity you're giving the assets to. Again, most of our clients are going to consider gifting cash versus long-term appreciated assets. There are complex strategies involving the gifting of businesses, business stock, or other tangible personal property items that could be in the range of art or collections that otherwise need to be considered in our much more complex beyond the scope of today's call. But again, that's where working with a person like a Jonathan Raymon from Baird Trust and his philanthropic specialty is going to be extremely valuable to you as you consider those options. Now, let's go through this AGI calculation. Again, I kind of gave you the Tom and Lucy scenario, but now I'm going to bring it down to a more basic scenario of a $100,000 AGI, or adjusted gross income, for this particular client. The client wants to give $70,000 of cash to a public charity, but remember their deduction is limited to 60% of their AGI. So they're going to receive a $60,000 deduction allowed in 2023. And the additional $10,000 of the unused deduction will get carried forward into 2024, right? Whereas if a taxpayer was to donate appreciated stock to a public charity, that deduction is limited to 30% of their AGI. That means a 30% deduction would be allowed, and $40,000 would carry forward for the next 5 years. Assuming the client had the same AGI of $100,000 in 2024, they would take another $30,000 deduction at that time, and they would carry the $10,000 forward to 2025. So again, think about the type of asset you're giving, the type of charity you're giving, and then looking at your adjusted gross income, we can then determine whether you'll receive the full deduction or whether the deduction may get carried forward for the next 5 years. It's also important we then realize if the deduction would go unused at the end of that 5th year carry forward, then what do we want to consider from a gifting strategy to achieve our client's philanthropic interest and still potentially benefit from that income tax deduction strategy? Okay. In addition to general gifting, I think one thing that many of us don't necessarily realize is the substantiation of charitable gifts. For example, a single gift of $250 or more, there must be contemporaneous written acknowledgement provided to the taxpayer for the taxpayer to include on their tax return. The substantiation must include the amount of the contribution, the description of any non-cash property, the date of the contribution, and a statement that no profit provided, the nonprofit provided no goods or services in exchange, that the individual and the nonprofit weren't seeking to give to me and I'll provide something back to you along the way. What I would note here is that the charity is not required to provide this acknowledgement unless requested by the taxpayers. Although we do see that most charities do send out this acknowledgement letter, as it is a best practice so that they aren't waiting for the taxpayer to come back and can help the client receive that income tax deduction by placing with all of their other tax work going into the year. But just understand that there are some cases out here in which we've seen the substantiation of charitable gifts not meet the IRS expectations of what forms need to be filed. And we've seen scenarios in which organizations and individuals have not received the tax deduction that they were expecting to receive without the appropriate documentation. So we've talked about using individual assets. We've talked a little bit about what type of charities and the fair market value versus cost basis and the deductibility. Now we're going to get into the using of retirement accounts. And one of the main strategies that we see individuals use is what's called a qualified charitable distribution, okay, known as a QCD. And with a qualified charitable distribution, the IRA owner must be greater than 70.5 years old. Now, again, this is not correlated or corresponding to the required minimum distribution age. When the IRS changed the minimum distribution age or the required distribution age, they did not change the qualified charitable distribution age. So it is still at 70.5. You can distribute up to $100,000 from the IRA to a qualified public charity. Now, this does not include giving to a donor advised fund, nor does it include giving to a private foundation. So most of the time with a QCD, we're seeing these gifts go directly to the charity. I would note that there are type of what I'll call a sister fund to a donor advised fund known as a designated fund. And the designated fund would act similar to a donor advised fund where you can predetermine the charities you want to give to and the manner in which you want those charities to receive the funds over a period of time. that would qualify as a QCD. But it is different than a straight donor advised fund where you are not required to distribute money from the donor advised fund to a specific charity in any given year. What's also interesting about the QCD is it also satisfied the required minimum distribution rules for a client, dollar for dollar. So when our clients do get to 73.5 and they are starting to enter that required beginning phase, that the QCDs that they are doing in that particular year can meet that required minimum distribution amount dollar for dollar up to the $100,000. For a while, we weren't sure if QCDs would be something that would be maintained on the system as a permanent, as originally there was no permanency with QCDs, but we do have through the PATH Act of 2015, the permanency of QCDs to be used by our clients going forward. So why do our clients use QCDs? First, the distribution doesn't count towards their adjusted gross income. As we think about retirees, this gets extremely important when we think about their Medicare premiums, for example. If we have to take a distribution from the IRA, right, as a required minimum distribution, and we add on another $100,000 to our income, that could spike up our Medicare premiums 2 years from that distribution. The IRS or the government's going to look at your Part B and your Part D premiums, and it's based off of what they call your modified adjusted gross income from 2 years prior. So if I take 100,000 RMD this year, 2 years from now, the IRS is going to look at my modified adjusted gross income from 2023. And in 2025, they are going to potentially assess me what we call an IRMA, or an income related monthly adjustment amount for that specific year, which means my Medicare premiums could increase for my spouse and I by about $900 a month more than if we were just paying the base level premiums for our Part D and B policies. Now that again, that would be a 1 year time, but if I do have these RMDs on a moving forward basis, the QCD can be helpful to try to keep that adjusted gross income lower, since the amount that I'm giving directly to the charity does not get added to my income, although it is satisfying the RMD amount at the same time. In addition, the QCD does not get involved with the charitable income tax or itemized deduction rules. There is no charitable deduction I'm receiving because I'm not also reporting it as income on my tax return. Okay? So I can avoid situations in which I might not otherwise be itemizing my deductions, especially if I was going to give a lower amount, maybe $5,000 or $10,000, and that wasn't going to be enough to have my itemized deductions exceed my standard deduction. And so in scenarios there, the QCD can be beneficial from a tax perspective in keeping my income lower, but it can also be beneficial because I can give directly to charity without impacting the standard deduction that I might otherwise take. So let's go through this as an example. Susan 73 has annual income from her brokerage account of $25,000, an RMD from her IRA of $85,000 for a total of $110,000 of income. Susan always gives 10% of her income between her church and the local humane society. So after her gifts of $11,000, but before taxes, she'll have a $99,000 in income available for the current year. So let's take a look at this. If, for example, Susan in this scenario were to give 10% after the IRA distribution, we can compute the taxes for Susan to be a total of $97,000 of income and a tax situation of $17,000. But what if instead Susan had done the QCD where she took her $11,000 from the RMD amount? She still has $74,000 of an RMD that she still takes, but she uses $11,000 of the RMD as a QCD and gives that directly to the charity. In this case, Susan takes the standard deduction as she was going to do prior, and we can see that it brings her income down to $86,000, resulting in a tax situation of $14,500. And let's face it, that's $2,500 of income that Susan can maintain, place in her bank account, and grow it, and potentially even use that in the community in a future opportunity. Okay. Another strategy we see with retirement accounts is focused on beneficiary designations or annuities and using beneficiary designations. So I'm going to stick with the IRA side. But these are assets that we call income in respect of a decedent, or IRD assets. There's no cost basis adjustment when I pass away on my retirement account. My beneficiaries will continue to have to take distributions, and then they'll have to pay the taxes on those distributions from a traditional IRA. Okay. Whereas if I were to name the charity as the beneficiary instead of an individual, well, the charity doesn't pay income taxes, and therefore the net amount of what I'm giving to individuals and charities, I can meet my ultimate goal of creating the ultimate efficiency, tax efficiency, by providing to the charity the retirement assets whereby they would not pay taxes, and I can give the non-retirement assets to individuals who might otherwise receive a cost basis adjustment, meaning I buy a stock at $10 and die it's worth $100. There's a cost basis adjustment, and my kids now have a $100 cost basis. They can then sell that stock for $100 and have no capital gain recognition. And so from a total efficiency perspective, we can now see a scenario where we can gift to individuals and we can gift to charity. And if we can design the right plan, we can create the structure in which everyone wins except for the government. So here's a scenario where Carol is 85. Majority of her assets are in a traditional IRA, which is now valued at $900,000. She has $100,000 of various other accounts. These could be brokerage assets or bank accounts. And she's volunteered at the local symphony and is committed to giving $100,000 at her passing to charity. But on her IRA beneficiary designation, she's listed her 2 children as the beneficiaries. So let's look at this plan. In this plan, here's the first $100,000 is going to come from the client's last will and testament, or maybe their revocable living trust, which we refer to as the client's governing document. And the retirement assets are just going to be split between the 2 children, who are going to ultimately owe income taxes on these distributions. And in this scenario, we can see that the charity does not pay any income tax on the $100,000 it received from the bank assets or the brokerage account assets. But the kids, as the beneficiaries of the IRA, are paying taxes on each distribution they receive from the retirement account. Okay, so the kids aren't really receiving a gross amount of, well, they're receiving a gross amount of $450, but the net amount actually passing to the child is less. Now, let's take that a similar scenario, and we say that the children get the assets from the brokerage account, in the bank accounts, the $100,000 there, with no income taxes due. The retirement account has 10% going to charity, or $100,000 still, whereby the charity doesn't pay taxes. The kids are still receiving $400,000 from the account, so the gross amount is still $450 to the kids, and the gross amount to charity is still $100,000. But in this scenario, the net savings to the kids is $30,000 combined by simply using a methodology of determining which assets to be used during your lifetime or at your passing to provide for the charities of your choice. Now, Jonathan's going to take some time here and walk through some of the different various charitable giving strategies and accounts that oftentimes we see our clients utilize. So at this time, I'll turn it over to you, Jonathan. I'm looking forward to the next section here.
Thank you, Scott. Sometimes the way to get the most impact to the causes we care about is to use one or more vehicles that are specifically encouraged by the tax code to promote charitable giving. Some of these might include donor-advised funds, private foundations, charitable remainder trust, charitable lead trust, among others. The 2 which I routinely get the most questions about are donor-advised funds and private foundations. At the heart, these are fairly similar. They both create funds which in turn can be given to operating charitable projects. And what this really allows is it allows that donors can be ready when the greatest need exists. In fact, we saw this just a couple of years ago when donor-advised funds and private foundations actually gave the most during lean years when the need is most pronounced, because it's basically a bucket of money when those funds are needed. It also allows donors to be ready to adapt to a changing world. There's a lot of times when we don't know what needs are going to be anticipated in 10, 15 years. We might not even know what needs are going to be needed next year. Also allow those funds to be used by nonprofit leaders without them having to focus on things that they don't do well. We know that the nonprofit sector does what they do very well, but it's not fair to expect them to know everything. For example, a minister or social worker, may not be an expert in budgeting and finance, but they do know the needs of the local community and they do know how to help in the local community. And so we want to be able to let them do what they focus on and take some of that investment need off of them. Donors also want to be able to have some ability to ensure that donations actually align with their values. And lastly, donors frequently want to establish a legacy and live on through their gifts. And this is very important because the charities that they've supported throughout their lives have depended on that financial security. And all of a sudden, the statistic that Scott mentioned earlier on was that even though we give to charities throughout our entire lives, immediately when we pass away, a lot of times that annual gifting that those charities expect ceases. And so to be able to regularly support those even afterwards, very important. Now, donor advised funds and private foundations, either one helps control the timing of distributions. They both allow donors' preferences, how to fund, and some control over those distributions in future years. They also both allow those funds to be invested to grow for the ultimate charitable impact. In each of these cases, the funds contributed are completed charitable gifts and cannot be returned to the donor. So one of the reasons why you might want to control that timing is for bunching strategy, which is from a tax perspective, there may be times when we want to contribute more to charity to get a deduction in a particular year, although frequently donors want to be able to make annual charitable gifts. And this is a strategy that can be easily accomplished with a donor advised fund. And I've got an example here. Now, in the first column is maybe the normal strategy where we have a donor who consistently gives $10,000 every year. Now, they have those charitable gifts of $10,000. They might have other itemized deductions of $12,000. You notice those combined don't reach the standard deductions. So that individual, that donor, gets no tax benefit from the charitable gifts that they make each year. However, if this same donor were to use a vehicle like a donor advised fund and hold 3 years worth of distributions, that could still be parceled out to the charities they care about in $10,000 increments every year. You notice what happens in this scenario is every 3 years that donor saves an additional $4,000 that can either be used by the individual or can be used to make additional gifts out there in the community and have that much more of an impact on the causes that they care about. Now, while there's similarities between donor advised funds and private foundations, there are also still fundamentally different entities. A donor advised fund is a contract between a donor and a charity, with a charity ultimately taking full possession and control over those funds with some sort of promise to take the advice from the donor or the donor's family, those that they may name to help guide those distributions in the future. It may actually surprise many that the largest charity in the United States is not the United Way, Salvation Army, or the Red Cross. Instead, it's actually Fidelity Charitable Gift Fund. This is the donor advised fund sponsoring charity, which currently exceeds $48 billion to be used for charitable purposes. Now, your Baird financial advisor may work with multiple donor advised fund sponsors, such as Fidelity, and your financial advisor may be able to help you pick the most appropriate donor advised fund sponsor for your situation. In contrast, though, a private foundation is itself a 501c3 charity, with its own tax ID number and its own reporting obligation. In a private foundation, that foundation ultimately takes control and possession of the funds, but that private foundation may be run by a group of people, the grantor, grantor's children, or grantor's like-minded associates. This allows a private foundation to do some things that a donor-advised funds can't. For example, if you have an interest in awarding direct scholarships to individuals or grants to individuals, that's something that a private foundation is able to do. Likewise, if you want to directly make grants to international organizations, that can be accomplished by private foundations, as well as being able to make program-related investments. Another real benefit with a private foundation is actually being able to be reimbursed for some of the grant-making expenses. And the reason why this is significant is a lot of times if we are wanting to set up future generations and train them in that love of philanthropy and involvement in the community, we can actually make sure that those future generations become the leaders in their community and are able to take a prominent role in working together with other nonprofits. Overall, this chart does show a lot of these contrasts. I would say the biggest takeaway here is that donor-advised funds may favor ease, while private foundations favor ongoing control and involvement. And that may not be the same answer for every individual. That's why we'd always like to have these conversations. It's also specifically important because while a private foundation can contribute to a donor-advised fund, a donor-advised fund cannot go the other way. A donor-advised fund cannot be transferred into a private foundation. So having some of these discussions up front is always an important strategy. There are some scenarios that might favor one versus the other. If all we're looking for is a bunching of gifts and being able to have some ease in that, donor-advised funds definitely works. Anonymity is also something that really favors donor-advised funds. Private foundations are set up a lot of times for perpetual situations that can go on for generation after generation and have language as far as how that might operate 100 years into the future. It also allows that active involvement and distribution to individuals, international organizations, and program-related investments. Now, typically, for smaller funding values, donor-advised funds are more cost-effective. But when we're looking at larger funding values, a lot of times private foundations are actually less expensive overall. The one recommendation I would have there is to look at the real fees and investment options of both donor-advised funds and private foundations, and to really look at the all-in comparison of administrative and investment costs and the services that might be provided. Now, there are still times that you might want to use both donor-advised funds and private foundations together, remembering that you can go only from a private foundation to a donor-advised fund. But if you do have a private foundation and you want to have anonymity, you can transfer those through an intermediary of a donor-advised fund. You may also use a donor-advised fund if you want to build up and delay distributions in order to accomplish something like a matching grant in the community, or to be able to wait for a big capital campaign when those funds are needed, maybe a couple years in the future. Now, Baird Trust does work with families and individuals who want to set up private foundations, and we take some of that administrative burden off of those private foundations to make them maybe a little bit easier to operate like a donor-advised. When we might want to use some of these tools together, we might want to also think about a third vehicle, which is a charitable remainder trust. Now, a charitable remainder trust is a trust which first pays out to yourself as the donor, or perhaps other family members, others that you want to give to. But the key word there is the remainder value of that trust is paid to a charity at some point in the future. Now, this works especially well when a donor has a concentrated position in a low basis asset. And this could be a closely held business, a piece of real estate, a family farm, or in the example that Scott mentioned earlier, where there's an investment that has been held for a long time and is appreciated in value, and might want to avoid some of that capital gain tax by selling it in order to diversify. So there's really four large advantages to a charitable remainder trust. The first is simply that ability to diversify that holding. It produces an income stream for that life or term of the individual. It gives an immediate tax deduction in the year of funding. But perhaps most importantly, it allows the taxes to be deferred on that gain until the distributions are actually paid out. Charitable remainder trusts can be adjusted, and there's a lot of ways that you can structure them. I'm not going to go into all those factors right now, but it's something that your advisor is definitely going to be able to work with you as far as your goals to figure out the optimal way to set up that remainder trust. Some reminders there. These are irrevocable. Once that is funded, there is an income stream, but no additional encroachment on the principals permitted outside of that income stream. And there's not that flexibility. The trust determines how much is paid out every year. Again, there are factors that you can adjust there depending on the amount that's actually paid out, as well as the age of the beneficiary that, again, help determine what that deduction might be in that current year. But I want to actually get into a real example here where we have an individual who does have a total of $1 million in a common stock portfolio with only a $100,000 cost basis. Now, if all that individual wanted to do was diversify out of that position, they would realize $9,000 in capital gains at a 20% tax rate. That means that there'd be $180,000 in tax that would be due immediately upon that diversification, which means that 1 million changes into only 820,000 able to invest. But if we were to first move that asset into a charitable remainder trust, we would be able to have some different results here. First of all, we'd still be able to get that concentrated position diversified, but we'd have an income stream that the beneficiary gets $50,000 a year at a 5% distribution rate, gets an immediate tax deduction of about $100,000. But, and this is the really important factor, is that instead of having that $180,000 that's due in taxes that first year, because it's only 20% of what's actually distributed out to the beneficiary, there's only $10,000 of tax due that's due in that first year, and the rest is deferred in future years until it's actually paid out. If the goal is to make sure that the family members still receive their inheritance there, it is possible to offset that gift to the charity, which needs to actuarially be about 10% of the value of what's initially funded. Can always offset that with some insurance so that the heirs of the family are still accounted for. Now, a fourth potential vehicle is a charitable lead trust. Current interest rates and estate tax levels make these much less useful at the moment, but the higher exemption sunsets at the end of 2025. That happens as scheduled. We would expect a renewed interest in a charitable lead trust and are ready to talk to clients about that. Again, Baird Trust works with private foundation management, charitable remainder trust, charitable lead trust, as well as investment services to nonprofits. Now, the important thing to think about here is that you do have a team of advisors, and the most effective way to support the causes that are important to you is usually going to be unique to your circumstances and will require the input from your team of advisors. So your Baird financial advisor, along with your tax advisor, CPA, and your attorney, can help look at your entire picture to figure out what is going to accomplish those goals. And we're always happy to help work with you on that. The big takeaway from today, from both what Scott and I have talked about, is that there are a lot of opportunities out there for giving. And these are rewarding, they can be tax efficient, they can be flexible with your goals, and they can be supported by your Baird advisor. So I look forward to continuing this conversation and any questions that you may have.
Awesome. Thank you so much, Jonathan and Scott. I know that you guys have been responding to most of the questions through Q&A, but I will remind the audience, you can ask a question by submitting one via the Q&A icon on the bottom right-hand side of your screen. I'll just ask again that you submit those questions to all panelists. Scott or Jonathan, anything coming through on your end?
I'm not seeing anything new.
Okay.
I will just bring up a couple common scenarios of when private foundations might be useful, because it follows frequently about 4 different types of scenarios. One might be an individual or couple with no children there, and they're looking for a way to make their estate actually have a meaning and purpose behind it and not simply go to the government or anything else. A second might be an individual or couple who might have children, but they don't want to disincentivize their children. And so they want to leave only a certain amount to their children, and they know there's still extra dollars that are there. Not only does this limit and make sure that those children are not de-incentivized from working, but it still lets those children really be set up as leaders in their community because they're the ones that can be involved in the running of the foundation. The next might simply be someone who has reached that estate tax exemption, and they just want to avoid that estate tax, which can be pretty draconian at 40%. And the last one that we see actually is something that might be set up frequently during life when you're actually wanting to involve your future generations, your children, your grandchildren in that philanthropy. And I've seen this work with multiple generations where families can actually work together in giving away on an annual basis, being thankful for what they have and giving back. But it lets the family have a reason to get together across generations and really have a positive impact, not only for the community, but for themselves as well.
Jonathan, I think that's a great call out, and being able to bring in the younger generations into the philanthropic world by having that conversation and utilizing whether they're assets that you just have in your bank account or a donor advised fund or a private foundation, and being able to have that conversation within the family. I think one of the best success stories I've heard of is a family that would get together on an annual basis and they would ask their grandkids to submit and to have a conversation with the family about what organizations they wanted the family to contribute to. And so they would ask their kids and grandkids to bring forth a proposal of which charities they thought could use some of the means. And sometimes you might find a child that has other friends or family members that they think would otherwise benefit from that charity receiving money. It could be something that the child is involved in as well, and that they could use the money for a variety of things within the organization that the child is involved with. So bringing forth those next generations and putting in their mind, giving back to their communities is a very powerful means of growing future generations into this philanthropic world.
That's such a great tradition to incorporate into Thanksgiving.
Absolutely.
And I do see a couple questions that just came through. And yes, one of the questions was just reiterating that idea and confirming that when you have a tax deferred account, whether it be that 401k, whether it be a traditional IRA, that's kind of counter to what most people do in their estate plan. Kind of the common setup is to just say, well, I'm going to give this amount to charity up front, and then the rest goes to my children. And so a lot of times children are the beneficiaries of those retirement accounts, but those children are always going to pay that ordinary income on the distributions from those tax deferred accounts. It's always better to shift and make sure that the charities that are tax exempt are getting those tax deferred account, and the assets that might have gotten a step up in basis, that's what we want to make sure to leave to our children, because then there's no tax consequences to them.
Great, thank you, Jonathan. I do think that is it for questions that have come through thus far. So I will give kind of a final wrap up here, but thank you everyone for your time today. And Scott and Jonathan, thank you both again for your comments and candor. We really do appreciate you guys joining today. For those of you that do have additional questions or would like to continue the conversation, please don't hesitate to reach out to your Baird financial advisor, and they will be able to loop in the appropriate resources on our end to continue that discussion for you. So thank you again, everyone, for your time. Scott and Jonathan, thank you both again. We really appreciate it, and have a great afternoon.
Thank you.